Imagine yourself as a US military. Constantly you're navigating the fog of war to deter an escalation of conflict while maintaining national interests. Yet, something as simple as a routine exercise of the Chinese military in the South China Sea could pose a risk. Recently, AI models running on satellite data detected an increased level of military activity. To the north in the southern Taiwan, you detected an alarming buildup of fishing vessels surrounding a major Taiwanese port. You detected many of those ships are tied together, suggesting the motive of a blockade. Taiwan is extremely reliant on freedom of navigation through international waters to ensure free trade. This free trade is extremely critical because Taiwan supplies 80% of the world's semiconductor. The device you're watching this video on relies on this part, and any disruption is disastrous. As you're monitoring the situation, the Japanese intelligence notified that the Chinese destroyer Luyang has gone dark and has disappeared from the intelligence feed. It has departed from the South China naval base, but you're not sure where it is headed. Gotham, a Palantir software, combines multiple data sources to project a likely path for Luyang towards the military exercise area or towards the Taiwanese port. You zoom into the fog of the path, and yet the system suggested that there is not enough data. Palantir's Gotham system then recommends a few alternatives to gather more intelligence. Before deciding the solution, Palantir's system provides the possible incoming threats from the types of possible military ships, the equipment available, and also their weapon system. The unmanned aircraft is then deployed to investigate the area. And the ship identification model detected a ship that matches the dimension, speed, and weapon system of Luyang, heading north towards the most dangerous path. To resolve this conflict, the system showed several alternatives. However, some are time-consuming, some are too high risk of conflict. And the third solution involves diverting a US military vessel to the area, showed as the fastest solution with the least risk and the highest probability of success. The American vessel is tasked to order to the area as you monitor how the situation progresses. As the American vessel approaches, the fishing vessel blockade began to disband, and Luyang the destroyer continues north without any incident. While this example is notional, incidents like this happen more often than we imagine. There are many moving pieces, and imagine as a US military, you need to make lightning fast decisions while assessing the probability of success and also assessing the risk level. Palantir solves this problem by integrating immense data in order to form predictive insights and help with global decision making, to suggest the next best available alternative. Data is everywhere in our life, in the way we work, and yet this data is huge, it's constantly moving and siloed into different systems. It is disintegrated. I'm sure those of you who have worked with the supply chain, myself included when I was a product manager in the pharmaceutical industry, find that supply chain is a challenging solution. There are so many moving parts, and yet different stakeholders are holding different timestamps on the inventory level, and therefore they have a different understanding. Each of us are working in a separate silo of systems, and therefore the data is not integrated, and yet this data is constantly moving, and we need to make time-critical decisions. You cannot just over-order the inventory, unlike what my ex-sales manager used to think, because this would jam up the supply chain. How do we optimize the allocation on the inventory while ensuring that there's no wastage? Because if we do not allocate it well enough, manufacturing firstly will overproduce much more than they needed to, and at the same time this leads to wastage because the inventory has an expiry date and also there's a write-off cost. So how do you optimize the allocation of the inventory? This is where Palantir comes in. It is about data integration and analytics. Palantir software is able to integrate big data to form predictive insights so as to streamline decision making. Similarly, you can imagine Palantir to be relevant in other sectors such as healthcare industry, in managing pandemics such as the C-19, in supply chain, manufacturing, military, and also finance management. In the case of C-19, Palantir software is able to predict where the next wave will be so that health authorities will be able to track and trace and contain the contagion. In fact, it is using Palantir software that the US military is able to track down Osama bin Laden. Fun fact, Palantir is named after Palantir in the Lord of the Rings, the Eye of Sauron that sees everything. Palantir offers three major platforms: Gotham, which mainly serves the government agencies such as FBI, CIA, and also US military, and Foundry, which mainly serves the commercial sector in manufacturing, in supply chain, finance management. Their clients include Morgan Stanley, Boeing, CDC, and NHS. And lastly, you have Apollo, which manages both Gotham and Foundry. What I like about Palantir is that it has a technological mode, just like Tesla. In fact, the US Air Force just straight up offered the contract to Palantir because no other vendor is able to do the job as good as them. There's no point in opening up a tender because there's no other available alternative. So remember to talk about the criteria of selection, having a moat, the proof of concept, and also the scalability. Having a moat, definitely Palantir has a technological moat because no one comes close. Proof of concept, definitely yes, because other major institutions, government agencies are Palantir's client. And also scalability. Many people think that Palantir is a consultancy company. They need to tailor their solution, but this is not the case, as we can see with Foundry. Foundry is a ready-made platform, and yet it has the flexibility to be able to tailor to the client's needs. In terms of financials, Palantir grew by 44% year over year, YTD at 1.1 billion, and they expect to close the year at 1.6 billion, which reflects a 45% growth over year 2020. We continue to see this trajectory over the past few years, which is a healthy sign for an early stage high growth company. Gross margin is at 78% because it is a SaaS company, software as a service company, and this is healthy. But you may see a net loss. How come the company, which has almost 80% gross margin but still lose money? This is because of the stock-based compensation, also known as SBC. If you look at the number 1 here, this operational cost included the SBC. SBC is a great way to hire great employees because Palantir as a software company, they need to hire the best talents, and yet they can't compete with top companies like Microsoft or Apple in terms of salary compensation. If they try to match the salary, it will not be healthy for the company's financials, especially in the early stage. And hence, a more efficient way is to issue stock-based compensation with the hope that in the future, as the company grows, so will their profit. So how much is the SBC? Year to date, it is 611 million, whereas the revenue is 1.1 billion. So this constitutes about 55% of the company's revenue. However, if you remove the SBC, straight up you can see that the company is already making money. Net loss, it is negative 352 million. But if you remove the 611 million of SBC, the company has an operating income of 349 million, which represents a 32% margin. The SBC may be high, which may turn some investors off, but notice that the SBC has also drastically reduced over time. In fact, the CEO Alex Karp has been exercising his options, which most of these options are set to expire by end of this year. So what this means is that moving forward from next year onwards, most of this stock-based compensation would be drastically reduced and would not be reflected in the future balance sheet. Now, we want to look at the cash flow of the company. As you can see, the asset to liability ratio is 3:1. Meaning to say it is 3.2 billion versus 976 million. This is very healthy. If they want, they can just use the 2.3 billion to offset all their liabilities. The best thing is, if you look at the debt, it is actually at 0. Previous quarter it was 200 million, but they have paid it off this quarter. Essentially, you want this kind of company during high interest era as the Fed starts to taper next year. Why is that? Because remember, based on the DCF model that I shared previously, the interest rate affects your discount rate, and therefore this would reduce the valuation of the company. However, if the debt is minimal or 0, it will not affect the discount rate, and therefore the valuation of the company will be intact and will not be affected. Another great thing about Palantir is that the total remaining deal is at 3.6 billion. The total remaining deal is the existing contract that Palantir has for the next 4 years. This means that for the next 4 years, even if Palantir do not bring in any new business, they still safely have a 900 million in sales per annum. And this accounts for 80% of their year 2020 revenue. However, because of the customer stickiness, this revenue is likely to be recurrent even beyond the 4 years because simply there's no other alternative. If you look at the bottom right corner, the remaining performance obligation is at 874 million. The performance obligation means that the work has already been completed but not invoiced yet. This means that these are the future sales that will be reflected in the future financial statement. And mind you, back in Q2 alone, Palantir has managed to capture a deal of 925 million. In October itself, they have also signed a separate IDIQ contract with the military worth 823 million. This 823 million is not part of the 3.6 billion that we talked of earlier. IDIQ stands for indefinite delivery, indefinite quantity, meaning the fulfillment of the contract is not fixed and there's no statement on how long this contract will last. It's intended as confidential because of the nature of the contract being a military contract. But knowing this is a military contract, we also know that the US government will definitely allocate an annual budget to it, and therefore this amount is more or less fixed. So the implication to this is that Palantir can easily 2 to 4 times its revenue in the next 2 to 3 years. Another point to note for Palantir is the client concentration. Ideally, the client concentration should be more dispersed so that if you lose one client, your business impact is lesser. But Palantir's client concentration may be too condensed in my opinion. The top 20 customers contribute 40 million per client in the trailing 12 months. This translates to 800 million in total. And in total, their revenue is expected to be 1.4 billion. This translates to roughly 60% of the total revenue, which is a bit too high in my opinion. Also, if you look at the revenue breakdown, the government sector contributes 60% of their revenue, while commercial is at 40%. This ratio has not changed since last year. Ideally, we want more weightage towards the commercial sector and also more expansion towards the international business. Even though commercial revenue grew by 37%, but the overall growth rate is at 44%. So ideally, you want the commercial sector to outgrow the overall growth rate. Also, if you look at the US commercial growth rate, which is at 103%, versus the overall commercial sector of 37% growth, what this means is that there is a slowdown in the international market expansion. It could be because of Palantir's association with CIA, with US military. This could be a potential barrier to the international market. However, a good sign is that the total customer count has increased by 20%, from 169 to 203. Hopefully in future there's more increased revenue from these clients, which will dilute the client concentration and mitigate the risk of reliance on government clients. Overall, the business is growing aggressively, which is a healthy sign. And also we do see that the financial is healthy with 3:1 ratio of asset and liability with zero debt. Let's have a look at the valuation of the business using a DCF model. In my valuation model, I'm forecasting a more aggressive growth in line with the company's forecast, which, taking into account the existing business and the future contract that was being signed, I think this growth rate is reasonable. In the year 2021-2022, I'm still assuming the impact of SBC, but gradually this SBC impact will be removed in year 2022 and completely by year 2023. As we can see, in this year itself, most of the options would be exercised. Being a software company, I'm assuming a conservative EBITDA of 35% through 50% by year 2026. Taking into account the gross margin as 80%, this EBITDA margin is conservative. It should easily be 65%, but to be conservative, I kept it at this rate. For discount rate, I put a 10%, although with zero debt, the discount rate can safely be reduced to 7%. So based on the multiple of 25, which Apple has a multiple of 30 and Amazon has a multiple of 60, the company share price should be $37. I did not factor in Palantir's cash of 2 billion and zero debt. If I factor those in, it should add another $2 to $3 to the share price. However, this valuation is adjusted based on present value. If I remove the discount rate, the stock price should be $60. Meaning based on the current trajectory, the share price will be $60 in year 2026, but in year 2021, it should be 37 based on the discount rate. Based on the perpetuity method, the stock price is $25. This means that at $25, you can still safely expect a 10% per annum growth, since I assume the discount rate to be 10%. Now, if you're lost on how this valuation method works, you can refer to my previous video, link in the description. Or alternately, you can just Google discounted cash flow and there will be tons of tutorial on it. So, I hope you find value in today's video, and if you do hit the subscribe button so that you do not miss out content like this. And also do hit the like button, it will help with the YouTube algorithm and also support this channel. Overall, Palantir is my second largest position, and I intend to hold it for the next 10 years, provided that the fundamentals remain the same. In the short term, you may not expect much changes to the stock price. In fact, it may even be volatile for the next 2 to 3 years. So if you cannot stomach volatility, and if you think that you may not be patient enough, this stock may not be suitable for you. However, fundamentally, this company remains strong, and also the financial of the company is healthy. Don't expect this stock to be another GME or Shiba Inu. But at the same time, I also feel that many value investors do not do it enough justice by saying that it is overvalued. They just take the financial report, read it at one glance without doing any deep dive analysis, judge that it is overvalued, while overlooking other more important details such as the IDIQ contract, the total remaining contract value, and also the value of sales that was not being invoiced yet. They also overlook the fact that this company is able to secure 900 million of sales in just one quarter alone. Realistically, I'm more comfortable with an investment with a high probability of success that can give me 3x in 5 years' time, and this is what Palantir offers. Taking aside the past 2 years where the market is crazy, it is hard to find an investment that can give you 3x in 5 years' time. And if you analyze it, this translates to 30% per annum. And just for context, Warren Buffett's Berkshire Hathaway only yield a 20% per annum ROI. So I hope you learned something today, and as always, invest safe, take care, and love you guys.